Finance fam, welcome back to my channel. The stock market is selling off, Bitcoin is selling off. What is going on with these markets? Inflation, interest rates, the economy, all the things. Let's get you updated. I wrote about the S&P 500's channel of doom a lot in the Daily Doe newsletter. If you're not subscribed, go subscribe. It's free. And basically, the S&P 500 has officially broken down through the support level of this very strong channel that we've been in since the beginning of 2024. Once this channel broke, we had a lot of things going for downside momentum. We had a stock market that was really not cheap. The valuation has actually been pretty expensive considering historic averages over time. We can take a look at the historic price to earnings ratio of the S&P 500, and this essentially is plotting it back to 1994. So it gives us the 2000 tech bubble, the 2008 financial crisis valuation. So it really gives us a nice backward looking range of what the S&P 500 valuation has been. And as we can see recently, before this correction that we're seeing right now, the S&P 500 has actually been trading on the higher end of the range, much above the 30-year average of 16 times earnings, and it's been trading around 21 times earnings. If we actually look at the 2024 earnings estimates, it's expected to be $2.44 a share. So if we take the current price of the S&P 500, which is around 5,000, and we divide that by the earnings expectation for 2024 of $2.44, that gives us around a 20.6 times price to earnings ratio. So going back to this valuation chart of the S&P, we're right about there still. So we haven't really seen a deep enough correction in the market yet to justify a much lower valuation. So yes, first off, it's important to realize that this correction in the S&P is actually very needed because there just hasn't been value. When we're buying stocks, most of us want to try to buy stocks when they're showing value and they're showing a little bit cheaper or trading closer to the averages over time in terms of valuation. And we just haven't been able to see that because of just how strong the momentum to the upside has been. So I think that this pullback in the S&P 500 is a much welcomed and a much needed correction for this overall bull trend to be able to sustain itself, and continue for the long haul. So I am actually excited to see this happening. So far, we've corrected almost 5% from the highs. So I can definitely see us getting deeper, maybe at 8 to 9% correction, bringing us back to some major resistance that was prior resistance turned support. So I think that from a technical perspective, we could, see that 4,800 level in the S&P 500. And I still think if we do see that level, that's a very healthy, okay correction. It's nothing to be afraid of. If we do continue to see the stock market sell off, I can see dip buyers really being interested in putting capital to work. There's still a lot of money sidelined in money market mutual funds. Trillions of dollars added to money market mutual funds over the past few years as people moved out of stocks because they were afraid of recession, and they moved into money market mutual funds for safety of capital. Well, guess what? They missed out on these big stock market gains, and they're probably going to be interested in putting some cash, moving from money market mutual funds and moving it back into the stock market if a really attractive dip buying opportunity comes along. So I do think that this is not the end of the bull market. This is simply just a healthy correction that we needed to see to attract more buyers into this market. Let's take a look at Bitcoin and see what that's been up to. We've seen a really big run in Bitcoin since the beginning of 2023. It's basically just been trying to run for all-time highs, and it broke, and we had a new high. And we've been pulling back after attempting to make that new high. We just couldn't continue higher, and we've been pulling back since then. Again, right alongside, same idea as the S&P 500. When we have these big moves, this was a pretty significant run from the lows here to the all-time high. That was a almost 350%, run in Bitcoin from the 2022 low, when we have these major runs higher, we want the market to take a breath. We didn't really have very deep corrections this kind of whole way up. The corrections were there, yes, but they weren't super, super deep. So when we had this major run starting in January of 2024, going into that new all-time high, we really didn't take much of a breather. So I think that this as a risk asset, risk assets are basically assets that people invest in to take on more risk. They have more volatility. Stocks, Bitcoin, things like that are risk assets. We want to see these overall trends kind of take a breather if they're going to continue higher. So, hey, if you were feeling FOMO at, 70,000 Bitcoin and you were feeling like, oh my gosh, I need to get in before it keeps running, well, you should be loving this correction. You should be loving it at 61,000 and any lower than that. So, I think that, again, this alongside S&P 500, no surprise at all that we're seeing this kind of cool down a bit. The reality is setting in the stock market that interest rates aren't going to go as low as they thought in 2024. In fact, interest rate cuts keep getting pushed back because of strong economic data. I don't want to call it strong economic data, but resilient economic data. It's resilient enough to where inflation has been stubbornly higher, and that's been concerning for the market. If inflation stays stubbornly high and doesn't continue to disinflate, the rate of inflation continue to go down, and interest rates don't budge, and we continue to see these stubbornly higher interest rates for longer, well, that is not good for the stock market. It doesn't enjoy that. The stock market wants to see lower interest rates to spur growth in the economy. More people will borrow, more people will buy homes, more people will buy furniture, and etc. And it just trickles down through the economy when rates are lower. So this pullback is absolutely understandable, warranted, and it's really nothing to get super stressed out about. Now, let's talk about inflation for a moment. So I wrote about this in the Daily Doe newsletter, but let me just kind of discuss my thoughts around the inflation rate. Should we be worried? How are we looking at this going forward? Because inflation, the rate of inflation needs to continue to go down. We call that disinflation, for the Fed to feel comfortable reducing interest rates. The problem is inflation has kind of stayed persistently higher. We've seen it come down a lot in terms of the rate of inflation coming from 9%, and now we're in the 3% range. But we want to see that trend continue lower, and the Fed hasn't really seen that. We've just kind of seen this consolidation around the 3.5 zone. Here's the thing, two things. Here's why I'm not concerned about this so much yet. There are still lags that are happening from the shelter component of the consumer price index, which measures inflation. So the shelter component is what's measuring, our living situation, right? Owner's equivalent rent, basically rents or what it would cost an owner of a home to rent a home. And what we have seen is in 2023, we can see by this chart, the rental prices were actually starting to decline in about May, June. So the May, June, range, we were starting to see rents decline in 2023. Yes, they've started to increase again in 2024, but the time frame from basically June through the end of the year in December 2023, this decline has not shown up yet in CPI because of the lag. There's essentially, a 12-month lag. People are signing 12-month leases. So it's kind of difficult to get a full picture because this decline hasn't fully shown up in the most recent CPI data. The shelter component is the largest component of the CPI. It's going to move the needle the most. So if these declines in rent haven't shown up yet in CPI, well, we can expect that CPI will eventually tick back down. Not only that, historically, during periods of high inflation, we have seen periods of spiking or the inflation rate kind of spiking back after hitting a new low in history. So if we look back at two very important times where we had high inflation, we had in the 40s and then we had in the 70s. And nothing was ever, a straight line down. Let's look at the 70s, for example. We can see on this inflation run, we had disinflation begin. So the rate of inflation was going down, but we saw spikes in inflation temporarily a few times on the way down. So essentially, it's not going to be a straight line down getting from 9% to 2%. It's going to kind of trend and have its ups and downs along the way. The other thing that we need to be watching with inflation is oil. Oil prices have been ticking higher, albeit not too high to be too concerned yet. But if that continues and oil does, continue to get more expensive per barrel, well, that kind of trickles down through the economy, right? It's not just you putting gas in your car. It's all of the manufacturing and the things that are made with oil or oil, based products, that trickles down into the costs of different goods. So just something to watch out for. We've been kind of watching it closely, but so far it hasn't been too big of a concern yet. So hopefully it stays that way. All this being said, we're watching inflation, but I do expect to continue to see disinflation continue going forward. So what does this mean for interest rates? Because honestly, interest rates are like the link to all of this. If interest rates go down, people are going to want to buy stocks and the stock market can end up rallying back to all-time highs. Bitcoin could look attractive again because it's a risk asset. And people have more money, to invest when they're paying less interest on their debts or they're getting a loan that's going to give them a much better payment for their home. So things like that really can make a big difference in the economy. So what are we doing with interest rates? Well, the jobs data has been pretty robust. We're still expected to see positive GDP growth in the US. And the unemployment data looks really good. The unemployment rate is still historically low. It actually ticked back down to 3.8%. So interest rate cuts keep getting pushed back. Because not only is inflation continuing to kind of be stickier, but also the labor market is really strong. You can't have a recession with historically low unemployment. I mean, you could, but it would be really, really hard. So interest rate cuts keep getting pushed back. So our next rate decision in May looks like we're going to be staying put most likely. In June, again, very high probability that we're staying put in the 5.25 to 550 range. No change. There's a slight, higher probability in June that we see a rate cut, but, it's still more in the favor of staying put. It isn't until July that things start to maybe look more probable for rate cuts. So could we see rate cuts in 2024? Yeah, we definitely still could see rate cuts, and rate cuts are being priced in, but we're going to have to watch it because we thought in the beginning of the year that we were going to see a lot of rate cuts this year, and it just hasn't panned out that way. So it's very possible that rate cuts could continue to get pushed back, and we may not see a rate cut until the fall, maybe even the end of the year. I wouldn't say that the economy is strong. There are still parts of the economy that are really suffering and parts that are doing better than others. The job openings data has finally started to cool a bit and kind of normalize back to pre-pandemic levels. So I wouldn't say that things are super crazy strong, but I would say that things are resilient enough. Something I'm definitely watching are debt trends, delinquency trends, and the credit card delinquencies that are 90 plus days delinquent are ticking back up. Of course, this is the last data point that we have. They're gonna have to update this soon, and we'll get a new data point to look at, but this has been definitely concerning. We're ticking back up to pre-pandemic levels. Auto loans have also been a really big concern for people because a lot of people bought cars that were overpriced during the pandemic, and they're upside down big time on those loans. So, that's something that we've been watching too, including bankruptcies. Bankruptcies are another thing that I'm keeping a close eye on. We still have not reached back to pre-pandemic levels on bankruptcies or foreclosures, so that's a really good sign. I don't expect foreclosures to hit pre-pandemic levels, but we'll have to see what happens. But overall, the foreclosures and bankruptcy data looks healthy. We are still way lower than we were before everything happened in 2020. So that's a good sign. The real issue is the 30-day delinquencies on credit card data and auto loans. This is definitely concerning data, and it's starting to show cracks in certain consumer groups. The good news is mortgage debt tends to be the largest debt that consumers hold, and mortgage debts have looked very healthy in terms of delinquency rates. They're extraordinarily low, so that's a good thing. So all in all, I think that the stock market correction is an overall good thing. I think that getting better valuations, something that all investors should want to see, and we could even be looking at good dip buying opportunities in the stock market as well. According to the data that we have, it does appear that we're going to continue to see earnings growth. Now remember, the stock market prices based on earnings growth, okay? So there could be things going on in the economy over here, but we still see earnings growth in the corporations. So that is what we need to be paying attention to. And so far, we're expected to see pretty robust earnings growth in 2024 of around 11%. That could end up getting revised downward, but we are still looking at very healthy earnings growth for 2024, even if the estimates get revised lower. So what that's telling us is there could continue to be demand for stocks no matter what happens, as long as earnings are expected to continue to grow. I think I can leave it there for now. If you have any questions, go ahead and hit me up in the comments below. If you liked this video, want to see more of this type of, going over the data, going over the charts, let me know as well. Like this video if you liked it and found it helpful. Hopefully you're not freaking out and you're not afraid of this market correction and you're looking at possibly investing. I'll see you in the next video.